Treasury Secretary Steven Mnuchin and Trade Representative Robert Lighthizer are back in Beijing for another round of trade talks. Reuters reporting U.S. officials say China is making unprecedented proposals on forced technology transfers, a key sticking point to reaching any deal. Intellectual property and the enforcement of the actual deal remain some key hurdles as well. Joining us now is Shares CEO Joe Schulman. Great to have you on today.
Yeah, thank you very much.
So we were talking a little off camera in terms of what this all means. You know, I read that Reuters report and said, look, it's good news that China is coming to the table on certain issues, but enforcement still hasn't been mentioned.
Yeah, that's it. I mean, that's the key, right? I mean, it doesn't matter what they say. I mean, they've said plenty of things over the years. It's all about the enforcement, because what if they renege on their terms? What if they say all the things that we want to hear? They're going to relax intellectual property transfers. They're not going to force majority stakeholdership. Maybe they're going to say we're going to buy more agricultural products in the U.S. But if they don't do these things, then what does it mean? So we really need the enforcement. And I think the markets are going to respond to not only what they say in terms of the promises they make, but also they're going to respond to the ability for us to enforce whatever promises they make.
So let's talk about the market reaction, because we haven't seen a huge reaction to that headline. It seems like we've gone past the headline chasing. But we've also heard a lot of analysts come out and say there will be a rally on the back of any kind of U.S.-China trade deal. What will it take? What are the deliverables that are necessary in order for investors to feel good about where this process is?
Well, in 2019, as you know, since Christmas, we've had one of the strongest rallies ever. And in our case, we're up over 20% year to date, and the markets are way up in anticipation of a China deal. And so we've already built some of that in. But I think if a good deal comes through, and a good deal will be that there's discussion about IP transfers and majority stakeholdership, and there's enforcement procedures, I think we're going to see a 5 to 10% increase from whatever levels we have. And I think we're going to go through the 2018 highs, because everything else seems to be in place. But right now, in the absence of a deal, I mean, people are talking about inverted yield curves, and what does that mean? And a lot of fixed income traders are a little nervous about this. And so, and because we've come off such a strong rally, 10 of the last 12 weeks, people are worried a little bit. There may be some profit taking. So I think it's going to take some enforcement procedures as well.
I want to ask you about the inverted yield curve in just a bit, but one more question on China. Do the tariffs need to be rolled back completely in order for investors to rally?
I don't think so.
Because that seems to be another sticking point.
Well, from my perspective, I mean, considering this is probably the biggest deal, I mean, a lot of viewers don't realize how significant, and this is a big deal, but I think it's one of the most significant deals that the U.S. has encountered in decades. I mean, when you look back in the early 1980s, when the U.S. had a $3 billion surplus, and where we are today in terms of the $300 billion deficit, and how China's gone from maybe 5% of the total GDP to now much higher. I mean, people don't realize that we're talking about trillions of dollars. So if we can have something in place, I mean, this is going to be the biggest movement, for many years.
Okay, on the inverted yield curve, we don't have a lot of time. We were talking about how, so many investors are jittery because this has been an indicator of a recession consistently. You have a bit of a contrarian view. You said you don't think they should be as concerned.
I personally don't see that. I mean, when you go back over the last 60 years, which we've done, and we've looked at monthly data in terms of, the spreads between the long bond, the 10-year bond, and the 3-month Treasury bill, we've had hundreds of cases where there's slight discrepancies, slightly negative yield curve. Right now, there's maybe 3 basis points, 5 basis points, and for the viewers, a basis point, 100 of them is 1%. So you're talking about basically the same thing. And we've had lots of situations throughout 2006, throughout early 2007, where we had what is considered a slightly negative yield curve. The markets still want a 5, 10, 15%. It's generally when we're more than almost a 0.5% difference, like 50 basis points or 0.5%, where things traditionally are not good. And we also have to recognize that the interest rates historically, by historical levels, are really low. And as many of your viewers know, I mean, there's $10 trillion in overseas markets where they have a negative interest rate, $10 trillion in Europe. So, I think things generally are pretty good here. We're going to see, I think, for the second quarter, we should focus on earnings because the first quarter is now in. So as the first earnings results come in, I think we have to focus on that and the China deal.